I'm Tony Wickenden, and I really thank you for joining us this session, looking at the budget announcements that we believe will have the greatest relevance for financial planners and their clients. So a focused rather than a more broad-based approach. I'm delighted to be joined in this endeavour by my esteemed colleagues and friends, co-director Claire Trott, who's going to be taking you through taxation of pensions and NIC changes, and senior tax and trust specialist Niki Patel and Marcia, who will be looking at income tax, capital gains tax, inheritance tax, and the changes to the non-dom regime. I'll be covering the changes relevant to businesses and business owners. Hopefully you're in for a treat, he said confidently. As you'll be aware, the budget delivered a combination of increased taxes, a changed definition of debt leading to the headroom for borrowing, resulting increased expenditure on public services and increased investment, the latter with the express aim of generating that all-important economic growth. In this event, as I said, we're going to be focusing on selected announced taxation changes and what they might mean for financial planning strategy, you and your clients. Before my colleagues and I delve into the detail, here's a short summary of the key announced changes. I'm sure you don't need this summary, but I'm going to give it to you anyway. An increase to employers' national insurance contributions, a significant reduction in the secondary employer threshold for national insurance contributions, an increase in the rates of capital gains tax, CGT as we call it, an increase in the CGT rate payable on gains made from the disposal of assets qualifying for business assets disposal relief, we used to know it as entrepreneurs relief, carried interest for private equity partners taxed at an increased rate. And at this point, it seems to me that, and you'll hear this from my colleagues, that there's been a few compromises made as a result of representations made in relation to changes we had been expecting and those that we actually got. An extension of the freeze on the inheritance tax nil rate ban and the residence nil rate ban, material changes to business and agricultural property relief, really important those, and removing the exemption from inheritance tax for, I love this phrase, unused or leftover pensions. More on that from Claire, as I said. Right, the extent of these tax changes announced reinforce, in my opinion, the absolute importance and value of informed advice. This is especially so, it always has been, when big personal, economic and taxation change takes place. Only advice, and I've experienced this over many, many years, only advice grounded in a knowledge of the taxation context in which these choices are made and the circumstances of what is important for your clients, of course, can help individuals and businesses to be aware of the choices that exist. That's really important, knowing that even a choice exists and how to make the choices that best enable optimum outcomes to be delivered. Right, probably to the amazement of my colleagues, I managed to get through that introduction without making a single kind of hammy Halloween reference. And I'm now going to kick off proceedings proper. Some of you have already submitted questions, and you can submit live questions in the Q&A box. You saw that on the notice on the opening slide. Some, maybe even many, of the questions that you submit or are going to submit will be answered by our presentations, and we'll look to answer as many of the questions, the other questions, as time permits, either as we go along or at the end of the presentations. So I'm now going to hand over to Claire to get into the weeds of those pensions and NIC announcements. Take it away, Claire.
Thanks very much, Tony. Well, I think we're all safe to say that we're very grateful that there hasn't been a cut in tax-free cash. We're not having to deal with the fallout of suggesting that that was something that that people shouldn't be accessing. So it was a win. We knew it was the right thing that that we should be doing by not doing that. But then there was leakage on the fact that there may be some changes to IHT in pensions, but actually most of us didn't think that was likely to happen. It comes down to the why they're doing it. And I think there's a lot of why they're doing it within what they're actually doing. So let's just look at the detail to start with, and then we'll look at the plannings and maybe the whys after. So it was a one-liner in the budget. The one-liner basically says unused pension funds and death benefits from pension schemes will fall into the estate for IHT. That seems very, very broad. What it didn't say necessarily, it's not until April 2027. It will be on deaths from that point that we will be looking at. There is a consultation, but I've already had a number of questions about this consultation. Is the consultation going to mean that they're going to backtrack, they're going to change it? Is there a chance that this will just not happen? Currently, the consultation is a technical consultation. It's purely about the hows and the whys, and not even the whys, the hows we deal with it, the how that the pension scheme will dealing with the personal representative, how the tax charges are paid, how things are calculated. So those sort of things are in the consultation, and there will be representations made on various different things in addition to that, I think, because there was a number of things that haven't been thought through, and I've seen a few of those coming through in the questions. So your brains are obviously working the same as me. So first off, what is included and what isn't included? So what is included is DC pensions that are left as a pot, generally on death. But if you go to things like defined benefit schemes, where the death benefits are paid under a scheme pension and they are a guaranteed pension, so you cannot unwind them, you cannot cash them in, so there is no way to pay a tax charge from them, then they are excluded. Interestingly, they are public sector schemes as well. So all of the public sector schemes are defined benefit schemes, so they will be excluded. In addition, under the same vein, annuities purchased under a life policy in life that has a ongoing pension, ongoing payment to a spouse on death, then they are also excluded. Again, probably for the same reason that you can't cash them in, so you can't use the funds to pay the tax charge. So that's kind of the thinking about the things that are excluded. In addition, charity lump sum death benefits are excluded, but they're a very defined pension payment to charities on death. Not everything would fall into that if it was paid to a charity. So just be mindful of the fact that it has to tick all the boxes to be a charity lump sum death benefit paid to actually be excluded. The next thing to consider there is what is included, because it's not just pensions themselves. There will be death in service that are structured underneath a pension scheme. So on death, the death in service falls into the pension and then is paid out from the pension scheme. They are included. So they will be included in the calculation. And as we know, they can be quite significant. We are under the impression, because accepted group life policies are not pensions. So we saw a big move on death in service to those with the limits on the lifetime allowance. We might see more moves with these changes. They are not part of the pension, so they do not fall into these changes. Doesn't mean they can't change them in the future, but it means they're not included in these changes. So how does it work is the next question. How it works is basically it's the value of the pension immediately before death that is used, and it's added to the estate to determine whether or not there is a tax charge. That includes the usual IHT rules. There's nothing different about this. So it's just the value that we're looking at. It's added to the estate to determine all the IHT rules that surround that, nil rate bands, resident nil rate bands, etc., etc. The value of the tax charge is then proportioned between outside the pension and inside the pension. And that tax charge itself will fall on the pension scheme itself and should be paid by the pension scheme. There is currently nothing in what we've seen to find the ability to move that tax charge out of the pension scheme if you can't pay it from there to the personal representative, or vice versa. So if the personal representative tried to challenge and get some more of the tax charge paid from the pension scheme, that's not an option either. There will be discussions between pension schemes, personal representatives, HMRC to make sure that all of this works and that all the right information is collected to do that. Once we've been through that IHT process, all the normal rules around death benefits and pensions apply. So if you are pre-75 and you've paid an IHT charge and it's gone into dependents drawdown, for example, that income will be paid tax-free. So income tax-free, there will be no additional charge. It does still apply, though, to post-75 death benefits. So if you are post-75 when you die, you pay an IHT charge on some or all of your pension, and then you will pay, and then your beneficiaries will pay income tax at their marginal rate when they take money out. So this has been very talked about a lot in the press this morning with this double taxation. And we should remind people that it's your marginal rate. So this could be 20, 40, 45. It could be whatever, if you're Scottish, I should say, because I can never remember all the tax rates because there are so many, but it will be more. So that is a general stance on that one. The Scottish are paying more income tax. So this will hit them even harder. There is also the issue surrounding special lump sum death benefit charge. So that is after the age of 45, the standard 45% tax charge if you pay those death benefits into a trust at that point. So if you pay the benefits into a trust pre-75, IHT at outset, possibly depending on your estate, and then the residual could be paid to a trust tax-free within the lump sum and death benefit allowance. See, allowances everywhere. This is getting very complicated. Post 75, you might pay your IHT depending on the size of your estate. And then as the funds are paid from the scheme into a trust, so a bypass trust, generally, then they would suffer a 45% tax charge on the way in as well. And that again is paid by the scheme. So the scheme might take 40% to IHT, then they might take 45% and then put it in. The 45%, however, we must remember you can get a tax credit when those funds are paid out of that estate to the beneficiary. So it's not lost, unfortunately. What it does mean is you're investing significantly less when it's going in. It all sounds a bit doom and gloom, but with it comes other IHT benefits in the same sense that we still have the spousal exemption. So the spousal exemption works that it's just not included. So that's absolutely brilliant for people who are just leaving all their death benefits to their spouse. So it may be a case of considering what you do on second death versus what you do on first death, because it wouldn't be falling into the estate. But again, the same rules that you might, if you leave other assets to your spouse and you leave your pension to someone else, they might still be able to use the nil rate ban, for example. So there are all those things. We just need to treat pensions as if they're any other asset in the estate. To a certain extent, because from what I can see, there is no look through to what assets are actually held within the pension. What we are going to see, actually, before I touch on that, I should just say this does also include overseas pension schemes. So if everyone's going, I'll transfer overseas, we'll get rid of this. It includes overseas pension schemes, QROPs, for example, QNUPs, which are generally have been set up in the past purely for IHT purposes and purely for death benefit purposes. So they are going to be brought into this. So if it looks and feels and smells like a pension, which is the general test, then that will also be included and dragged back in. This will also apply for anyone who is already in receipt of beneficiaries drawdown, for example, not now, but on their death. So just because it's not been tested on first death doesn't mean it won't be tested on against IHE on second death, because it does look at nominees and successors' benefits as well. So at any point we're looking at passing it down a generation or even sideways, then we will be testing against inheritance tax. This, what will really mean for people is really considering whether or not we should be accessing more of our pensions income further sooner rather than later. The general stance for many years has been, let's push taking pensions until the last, because it's the most tax efficient in life and tax efficient in death if you're not spending it. But that actually might move now, which for me, I think is the real reason why this has been done. It's not for the IHT take, because the IHT take will probably still be fairly negligible in the grand scheme of things. But it's to try and encourage people to use pensions in the way that they are designed. And what they are designed for is to provide an income in retirement. What does that mean? Taxable payments out. So more tax to the revenue at that point, because you're going to draw money out, you're going to pay income tax, and then you're going to spend it, rather than keeping it to one side and that income tax being deferred and deferred and deferred until someone post 75 dies. Planning wise, again, looking at the holistic planning, the all asset approach to retirement, and making sure that we understand what all the different assets our clients have to be able to determine the best way to access those. If the least tax you pay, the longer that your money will last. So again, utilizing bits of tax-free cash every year, but also thinking about things, if I get to 75, there's a much bigger driver to make sure we've used our tax-free cash, because it's not only going to be taxable on death, but subject to IHT quite possibly as well. So I think people will start taking money sooner. There's definitely going to be a drive for people not just using pensions for IHT planning, but for a lot of people, the tax benefits of contributing to a pension in your lifetime when you're working and maybe paying 45% tax is still huge. And don't forget, there's always the additional benefits of it reducing your adjusted net income, for example, for things like the £100,000 limit when you're losing your personal allowance. That's pretty much everything I'm going to say on that. I know there's a load of questions in the chat already about this, so I'll just check what we haven't covered and we'll come back to that a little bit later. The next thing just to consider about pensions was there was a loophole changed regarding transfers overseas. And those transfers overseas were really those where you remained in the UK as a resident and you transferred to a cure ops, for example, in the EEA or Gibraltar, and you used that as a facility to take additional tax-free cash, because once it's overseas, it doesn't use up your lump sum allowance or your lump sum and death benefit allowance, and the transfer itself only uses up the overseas transfer allowance, which is separate from those two. What they've said now is in exactly the same way as it would be if you transferred out of the EEA, say to Australia, for example, and you remained in the UK, you would be subject to a 25% tax charge on the whole amount. So the new rule is if you're not in the same jurisdiction as your money, then you will be subject to the 25% tax charge. That is purely driven so that people are not doing this transfer overseas, take my tax-free cash, and then maybe bring the residual back. We saw a lot of stuff in the press earlier in the year talking about double bubble tax-free cash for the richest people, and this is just closing that loophole. The reason the loophole there was really because of poorly written legislation and possibly a little misunderstanding how cure ops transfers really worked. There's probably nothing planning to do there, but if you've got anyone who's been thinking about it, then that loophole has closed. It's not it's closing, that loophole has closed, and any transfers where you don't go with your funds are going to be hit by that. Let's move on to national insurance now. National insurance, we knew that there's going to be no increases on personal national insurance, so employees' national insurance. That was made very clear in the manifesto, and they have stuck to that. However, for employers, we are seeing the increase from 13.8 to 15%, and this is a massive revenue raiser for the government. So, and we do know that obviously that's going to be a big impact for employers. The additional sort of double whammy with that one was the reduction of the employees' secondary threshold, bringing that much further down from 9,100 to 5,000, bringing many, many more employees into the realms of having to pay, or their employer having to pay national insurance on their behalf. So this is going to make a big difference to those people who are employing a good number of individuals, even on those who are on low pay. For example, it won't take that much before somebody on national living wage or national minimum wage does enough hours to trigger this. So something to really consider. However, they have given a small lifeline, which is regarding the employment allowance, which is generally a real benefit for the smaller employers, which they have increased that from 5,000 to 10,500 per year deduction. They've also removed some of the restrictions around applying for that. And the restriction there was having over less than £100,000 worth of national insurance paid in the previous tax year. So the changes to that have meant more people will be able to claim it. But the fact is that a lot more employers are going to see the impact of having to pay higher national insurance for more employees starting at a lower level. So real issue there. I think at that point, I'm going to hand back to Tony, and he's going to take the NI further and just talk about that for business owners themselves, which a lot of you will be on the call. So over to you, Tony.
Thanks, Claire. That was pretty much a tour de force. Thank you very much. I'm always so informed when you talk about pensions. And clearly, all you lot out there are really listening, because we've got over 100 questions just on that subject. So good luck with that, Claire. National insurance as financial planners, probably one of the most obvious areas, apart from the pensions aspect of national insurance, that you become involved in is at the end of the corporate year that you're looking at how to advise your clients, probably with another professional connection, as to how best to take the money from their business that they want to take from their business, i.e. money that's not going to be retained for working capital, or invested in pensions for the longer term, which is always the best way to extract money with least tax friction, of course. So we'll put that to one side as a given before Claire gets at me and says, you didn't mention pensions. Well, I have, so there you are. Dividends and salary, does that national insurance change make any difference? Well, let's remind ourselves there are three kind of moving parts to the decision making on how to take your money from a business, dividend or salary. And those three moving parts are these: corporation tax, income tax, and national insurance. Now, the corporation tax rate changed not that long ago. The ordinary, the main rate, to 25%. It was quite a leap from that unitary rate of 19. So we've got now 19% on profits below 50. We've got 25% on profits over 250, and that weird 26.5% rate in between, which is an effective marginal rate. So that's something that was relevant from last year, remains relevant. We do have the government commitment that in this Parliament, they will not increase that main rate of corporation tax above 25%. Okay, then we've got the income tax rate, which has remained with us as it is and will remain frozen until 2028, no longer than that. Niki's going to be talking about that in a minute. And then we have the national insurance rate, which has gone up. So if national insurance has gone up, surely that makes dividends more attractive. Yes, it does generally, but does it make them more attractive than salary? That depends on the three moving parts. As of last year, with the calculations we did, and everybody else did, I guess, that were part of this decision making, we determined that a dividend was the best way of taking your money out of the business. So many of the margins have narrowed quite a lot, but it was the best way of taking your money out of the business. Has that changed? Well, it was, except where the company was a 25% or 26.5% corporation taxpayer. And, important, and you as the receiver, the receiving shareholding director, were a 40% or 45% taxpayer. So 25% paying company, 26.5% paying company, higher rate or additional rate tax paying receiver, then it's better to take it out, only marginally, but better to take it out by way of salary or bonus. And that remains the case. It's narrowed the difference, but it hasn't quite been expunged. So dividends best unless you're one of those people taking your money from a 25 or 26.5% paying company and you're a higher or additional rate taxpayer. Who knew, as they say. Anyway, you do now because we've just reaffirmed it. What else is relevant for national insurance? Well, it'll be that lowering of the threshold is really important. The Institute for Fiscal Studies, I joined their conference yesterday, and they made it very clear that the OBR stated that the biggest amount that's generated from the national insurance changes comes from that reduction of the threshold. So that's something that will need to be factored into, those strategies where you're going to pay money to a lower working or less working spouse, etc. They might need to be reviewed. Maybe I'm not saying you shouldn't do them, but definitely review them in light of the change to that lowering of the threshold, because it will make national insurance paid a little earlier. So review those arrangements. Claire's already mentioned salary sacrifice or salary exchange. Definitely the national insurance impact will have, there will be an impact on working people. I think most people accept this, not directly, quite clearly, and the government have made that very clear, and they're right. It doesn't affect working people directly because it's an employer contribution. However, it is very clear the OBR, Office of Budgetary Responsibility, have stated that they believe that the consequence of that change will be borne 61% in wages. That increased national insurance will be flowed through and be reflected 61% in wages, 24% in profits, and 15% in prices. So in one way or another, people, including working people, will suffer as a result of that change. Employers are also going to have to deal with, and we've heard a lot about this through the news pieces on TV and in the papers, online or physical, of the impact of employers of all these changes of national insurance. The national minimum wage and the reduction of that threshold is going to make a difference. What difference it makes, we'll have to wait and see. The OBR have their predictions. It could well lead to more self-employment as well, is a thought that many have. If we're talking about business taxation, then we can't ignore those changes to capital gains tax, business assets disposal relief, which Niki's going to look at in more detail, and business property relief changes. They'll affect SME owners, and as SME owners yourselves possibly, and those of you that have SME owners who are your clients, they'll be really interested to know the detail of that, and you'll be getting that from Niki and Marcia. And of course, you can get that through TechLink in lots of detail through our budget bulletin and the follow-up bulletins that we'll be publishing. There was some fear that both of those reliefs could be abolished, but they haven't been. And rather like a number of other areas of taxation, there's been a kind of compromise made, as we'll see. Business assets disposal, it's not an easy one to plan for. I mean, it's all very well to go if the CGT rate is increasing as it has. I can sell some collectives before the the date that it kicks in, even though you can't because that was on midnight on budget night. But when of the day before budget day, yeah, midnight on the day of the day before budget day, midnight the 29th. So SME owners will definitely have that in mind, but it's pretty hard given that that change kicks in April to go out and sell your business in short order. As someone who has sold their business, it definitely wasn't in short order. It's a very happy outcome, but it takes a while to get that outcome. I think on that point for SME owners, it's a good point to remind them, I think, in relation to value, that the value that they're looking to get from that capital event, if that is their objective in running and building their business, is going to be very likely diminished by that change to business assets disposal relief, net of tax, that is. And also, it's a good occasion to remind individuals, in a non-patronising way, of course, that relying on my business as my pension is sometimes a very dangerous strategy, and diversification should take place. That isn't casting any kind of aspersions on the value of a business or the efforts of the person building their business, but just to say that, you know, markets are very difficult on certain occasions from time to time, and an unquoted business is largely illiquid, and so trying to get money when you want it might not be the easiest thing to do, and you might not be able to achieve your objective in the way that you want. Other aspects could impact on value, leaving aside tax on the net value. So diversification, putting your money into other assets, investing in pensions, investing in ISAs, makes sense as something other than just having all of your assets in one asset class, however much you love it and spend time on it. The other thing to keep in mind, I think, if you're running certainly a financial planning business, the importance in building value in that business of having intergenerational relationships. It's quite clear in looking at business valuations that increasing attention is being paid to the nature of the relationships you have within your business. If all of your relationships are with older people, much older people who are decumulators, the two Ds appear, death and decumulation, which impact negatively on value. So having intergenerational relationships down the generations built on real relationships and communication with those people in the way that they want to be communicated with is absolutely important, and it really does have an impact on value. It also has an impact on longevity of the business, which of course impacts the value. For those who just want to carry on running their business, better to be running a business with clients who are still alive and investing than clients who are no longer with you. Last point on business and business taxation is just a reminder: there is no change to corporate taxation in relation to corporate investment. For those businesses that have money that isn't required as working capital, isn't required for investment, isn't required to go into pensions or to distribute for the benefit of the owner managers, their money that is sitting long term can be invested, subject to all of the normal constraints that you would have and ascertainments of attitude to risk. Investments for companies are absolutely possible beyond leaving it on deposit. And if you are doing that from a tax efficiency standpoint, it remains the case that investing in collective investments makes absolute sense, especially for a company, because what remains with us is the fact that dividends paid from one corporate structure to another, which is what an authorised collective investment is, remain completely free of tax without limit, where they're not subject to that dividend allowance. They are tax-free without limit. So you get tax-free dividends from your investments, whether they're reinvested or taken, and deferment of the capital gain, which when it's realised is subject to corporation tax, not capital gains tax. Just a reminder on that point. So at that point, having covered the business tax aspects that I have, I'm going to pass you over into the very capable hands of Niki Patel to talk you through those all-important changes and much anticipated changes on capital gains tax and income tax. So Niki, over to you, please.
Okay, so what did we see in relation to the income tax changes? Well, as per the Labour government's manifesto, there were no changes announced in respect of the income tax bands, rates, or personal allowances. So what remains really, really vital is to ensure that individuals are taking advantage of planning options available to them. Do remember that obviously, because we haven't seen these changes in relation to the bands, once total income exceeds 100,000 or more, and that's the point at which the personal allowance begins to be tapered by £1 for every £2 of income above that limit, and it's totally lost when total income is or exceeds £125,140. So remember that this includes all sources of income. So earnings, rental income, pension income, and very, very importantly, your chargeable event gains on investment bonds. So you could actually have individuals that are, basic rate taxpayers. However, on realisation of a chargeable event gain, it can mean that while there might not be tax to pay on their bond gains because we're slicing, etc., they remain within basic rate, they could actually have loss of personal allowance. Also, the other income, you've got to take account of savings income as well as dividend income, and we did not see any changes to those allowances either. Interestingly, the decision not to extend the freeze on employee income tax and NI thresholds that had been implemented by the previous government actually has come as a surprise to many individuals. I'm not going to go into the national insurance changes, as that's been already covered by both Tony and Claire. So one of the things that was announced was that from 2028 to 29, the personal tax thresholds will be uprated in line with inflation. So that essentially in turn will mean that individuals will be able to earn more before incurring higher taxes. So in terms of general tax efficient planning, investing couples should aim to obviously use their dividend allowance, which, as I said, had not changed. So that's remained at £500. And then, of course, we've also got the personal savings allowance, which is £1,000 for basic rate taxpayers, £500 for higher rate taxpayers. Remember that your additional rate taxpayers do not benefit from the personal savings allowance, but also just to have their investments in such a way where maximisation of these allowances, all people are using them, is going to continue to be vital. Remember as well that something that we covered a lot in TechLink was about the ability to transfer the marriage allowance if individuals are eligible to do so. And it's really, really easy to check if you have got clients within this category. They can just go on the HMRC site, plug in some details, and that can all take place. So that's something to also think about. Consideration should always be given, and I'm smiling. I always say, I know nothing pensions, yet whenever I'm writing about it or I'm talking about it, think about maximising your pension contributions. Lots of tax savings, income tax savings, as well as CGT savings can take place there. And of course, making gift aid donations where possible will also help save tax. From a tax efficiency point of view, I don't feel from income tax at least that much has changed. So continue to talk to clients about maximising their ISA subscriptions. If they haven't, the limit did not change. So we're still at 20,000 for the year. And that is at the moment, as we know, frozen until 2030. And this is going to be particularly important for those higher additional rate taxpayers where their other dividends are likely to exceed the dividend allowance. So, within the ISA, everything is benefiting from tax-free growth. Investing in VCT shares will also appeal to some of your higher additional rate taxpayers, not only because they can benefit from that 30% tax relief against their income tax liability, but also because the dividends within the VCT are completely paid tax-free. And let's not forget that another alternative option are your investment bonds, especially for those that wish to benefit from tax deferral. And it gives a lot of flexibility with tax management generally. Finally, something that wasn't really mentioned on budget day, but something to just be aware of is with regard to the high income child benefit charge. So this begins to apply where income is 60,000 and and the benefits completely lost once that income exceeds 80,000, but it's based on the highest earner. What we did hear previously was the move to consider, moving this to a household income basis. However, something that was confirmed was that this is not going to happen. However, from April 2025, to make it easier for taxpayers to get their high income child benefit charge correct, the government is going to allow employed individuals to pay this through PAYE, or alternatively, for those not using that service, they can pre-populate their self-assessment tax returns with the child benefit data. Finally, there was some income tax changes which will also affect your non-domiciled individuals, as the government confirmed that the current remittance basis of taxation will be replaced with a simpler residence-based scheme from April 25. Those who opt into the scheme essentially won't pay UK tax on foreign income and gains for the first 4 years of tax resident, provided they've not been UK tax resident in the 10 years immediately prior to arrival. Those who previously used the remittance basis who are not eligible for the 4-year foreign income and gains regime will pay tax at the same rate as any other UK residents on newly arising foreign income and gains, the same way as any other UK taxpayer. But I'm going to stop that there because my colleague Marcia will take you through that in a bit more detail. So let's move on then to the much anticipated changes with regards to capital gains tax. I mean, leading up to the budget, there was a lot of speculation that the rates of CGT would potentially be aligned with the income tax rates. And actually, that was the case when I first started in industry, which was many, or what feels like many years ago, 24 actually, to be precise. But that didn't happen. And so a little bit of good news in terms of, the rates have increased, but not in line with our 45% income tax rates. Instead, what we've seen is an increase in the basic rate of capital gains tax from 10 to 18%, and an increase for higher additional rate taxpayers from 20 to 24%. So yes, this is a sharper increase for our basic rate taxpayers compared to higher rate taxpayers, but it's still not as harsh as it could have been had they increased in line with, as I said, the income tax rates. Remember that our residential property CGT rates on non-exempt property, so essentially a property that's not an individual's main residence, will remain at 18 and 24% respectively. And just remember that for tax on those gains, the CGT must be reported and paid within 60 days of completion. So no changes in relation to that. Unfortunately, sting in the tail is that the increased rates for CGT apply immediately. So for disposals made on or after the 30th of October, so as Tony said, from midnight essentially of the 29th, and individuals have just got the annual exemption of £3,000. So again, for a lot of people, consideration ought to be given to maximising ISA subscriptions to benefit from that tax-free growth in the future, and also making pension contributions, because that's going to be beneficial to higher rate taxpayers who could reduce CGT payable on some of their gains. In addition, think about that if there are some additional funds to investment bonds, and either UK or international is appropriate, can still, of course, be considered for those for tax deferment. And as I mentioned before, the general tax management qualities, especially where the investment has got a strong income component. One thing that didn't change, and it should really be noted, is that the revaluation of otherwise chargeable assets that continues to take place on death will be a continued benefit for your collective investments. And of course, that's not available to investment bonds. Let's not forget capital losses as well. You can still offset your capital losses against your capital gains. The rules here mean that, essentially any current year loss can be offset against current year gains before applying the annual exemption, which remains unchanged at £3,000. And where individuals have got some of those unused losses, they can actually be carried forward to offset against future gains, subject to a claim being made with HMRC. So ultimately, using brought forward losses against capital gains to reduce overall liability going forward is still going to be beneficial. And other planning can, of course, be considered in terms of transferring shares or units in unit trust to spouse or civil partner, because you can continue to use both individuals' annual exemption and potentially the lower rates of tax. Remember, though, that such a transfer must always be on an outright and unconditional basis. So what other CGT changes did we see? So as Tony briefly mentioned, rate of CGT on business asset disposal relief and investors relief on qualifying gains will increase from 10% to 14%, but this comes in from April 2025, and then further increase from 14% to 18% from April 26. The cumulative limit for qualification for business asset disposal relief remains at £1 million. So that's your lifetime limit, £1 million. But for investors release, this decreases from 10 million to 1 million. When it comes to business asset disposal relief, for many, those that are already potentially considering selling qualifying business or an interest that qualifies for investment relief, and for whom relief is relevant, may, and obviously commercial conditions permitting, wish to act quickly prior to these increased rates on the qualifying amount coming into effect. For any gains above this £1 million limit, remember that the new main rates of capital gains tax will, of course, apply. And finally, another CGT point, again, Tony did mention it, was CGT on private equity carried interest will increase from 18% for basic rate taxpayers and 28% for higher rate taxpayers into a single unified rate of 32%. From April 2025, and then from April 26, carried interest will be subject to a revised regime within the income tax framework. Not really going to go into any detail here, because in practice, this is unlikely to affect many individuals, as according to the government, it's only really paid by a small population of fund management executives. And then, of course, we did have, the CGT changes do also impact non-DOMs, which are going to be covered by my colleague Marcia. And on that note, I'm going to pass you over to Marcia, who's going to take you through the inheritance tax changes and also the changes to non-DOMs.
So Wednesday's budget was a relatively big one for inheritance tax. In addition to the announced changes to the inheritance tax treatment of inherited pension pots and pension death benefits that Claire's already covered, there were big changes for business owners, farmers, and non-domicile investors. Looking first at business relief. Under the current inheritance tax regime, business relief and agricultural property relief provide an effective 100% exemption from IHT in respect of agricultural and business property, including shares in unquoted trading companies, provided, of course, that the relevant ownership conditions are satisfied. From April 2026, these currently unlimited reliefs will be restricted by a cap, which will give relief at 100% to only the first 1 million of combined qualifying agricultural and business property, with qualifying property above this figure attracting relief at the lower rate of 50%. If the total value of the qualifying property to which 100% relief applies is more than £1 million, then the allowance is applied proportionately across the qualifying property, with any excess qualifying for relief at the lower 50% rate. So, for example, if you had agricultural property of 3 million and business property of 2 million, the 100% allowance for agricultural property would be given as to 600,000 to the 3 million of agricultural property and as to 400,000 to the 2 million of business property, with the remaining agricultural and business property all qualifying for relief at 50% only. Now, although we have little detail on the intricacies of the measure because we've only had a policy paper, we haven't had any draft legislation. Reading between the lines, it would seem that the allowance will be a lifetime allowance that will apply only to the first million of agricultural and business property combined that's transferred by the same transferor, whether that transfer is made during lifetime or on death. So a bit like the 1 million allowance that we have for business asset disposal relief. It would also appear that spouses and civil partners will each benefit from relief of 100% on their first million of qualifying assets, meaning that between them, they'll have a 100% allowance of 2 million, although the policy paper makes it clear that any unused allowance won't be transferable between them in the same way that nil rate bands and residence nil rate bands can be transferred between spouses and civil partners. Trusts owning business or agricultural property will also benefit from the 1 million allowance. And where the settlors created, this is quite generous, where the settlors created multiple trusts holding, for example, unquoted trading company shares, each trust will have its own allowance, provided that the trusts owned the qualifying property prior to budget day. Get that qualification in there before you start getting your clients to create multiple trusts of their business property, because where multiple trusts are established on or after budget day, anti-fragmentation measures will apply. So the million allowance will be allocated across all of those trusts. The restriction to agricultural property relief and business property relief will obviously be a concern for many business owners and their families who will now need to consider how to fund an inheritance tax bill without breaking up or selling the family business. While there's an option for paying in instalments, late payment interest at the new higher rate, which is currently 9%, would be due on instalment payments. It would appear that business owners and farmers in a position to transfer business or agricultural property into trust before 6th of April 2026 would be able to do so without any immediate inheritance tax charge, regardless of the value concerned, transferred. However, careful consideration of the long-term ramifications of doing that will be essential, especially that given that trustees whose sole asset is shares in a trading company, for example, may have very few options for funding their own inheritance tax charge other than taking a dividend from the company, which would be taxable in their hands at 39.35%, thereby increasing the overall tax payable to around 5%, not far off the 6% rate, which would apply to the assets held in the trust if no relief was available at all. In many cases, life insurance in trust may therefore be the best option for clients facing new liabilities as a result of these changes. And this will be especially so for farmers who might find it more difficult than business owners to make lifetime transfers of qualifying property without relinquishing control and inheritance tax efficient access. The other change to business relief is the reduction in the rate of business property relief available for shares listed on a stock exchange which is not designated as recognised. The alternative investment market is one such exchange. AIM holdings will now therefore only qualify for relief at 50% regardless of the value of the holding, instead of the 100% relief that they've historically benefited from. It's important to note that only shares listed on a stock exchange that's designated as not recognised are affected. So while the AIM shares are unquoted and hence qualify for relief under current rules, they are caught by the new measure. By contrast, unquoted shares in private companies, including those that are invested in via some of the products marketed by the likes of Octopus, Intelligent Partnership, etc., are not listed anywhere, and so are not caught. Although these will, of course, be affected by the $1 million cap that I just mentioned. So while this change introduces an effective IHT rate of 20% on AIM shares on the death of the investor, compared with the investment being fully mitigated for IHT purposes, the budget announcement has largely been welcomed by investors and providers, many of whom feared that inheritance tax relief would be eradicated completely for both AIM shares and unlisted portfolios. And of course, as I say, we do still have those unlisted portfolios that can be invested in and 100% relief obtained after 2 years of ownership. The other client cohort affected by Wednesday's inheritance tax announcements will be non-domiciled clients resident in the UK. We already knew that changes were coming, but a technical guide published alongside the autumn budget has provided a lot more detail. Historically, the extent to which inheritance tax is applied to a person's estate has been based on their domicile status, with UK domiciles and deemed UK domiciles being subject to UK IHT on worldwide assets, and non-UK domiciles being subject to UK IHT on their UK situs assets only. Non-UK domiciles who were resident but not deemed domiciled in the UK also had the ability to settle their excluded property, essentially their non-UK assets, but also authorised unit trusts and OICs, into trust before becoming deemed UK domicile. And this excluded property would then remain outside of the UK inheritance tax net, regardless of any future changes to the settlor's domicile status. Consequently, the excluded property wouldn't be included in the estate of the settlor, who would typically be a beneficiary of the trust, as a gift with reservation, even if he died domiciled or deemed domiciled in the UK. And the excluded property would also not be subject to IHT periodic and exit charges, even if the trust was a discretionary or post-2006 interest in possession trust. From 6th of April 2025, however, the concept of domicile will cease to exist for tax, including inheritance tax purposes, and a new system of taxation based on residence status will apply instead. For inheritance tax purposes, this broadly means that anyone who's been living in the UK for at least 10 out of the last 20 years will be subject to UK IHT on their worldwide assets. These people will be known as long-term residents under the new regime, a term which can also include someone who's left the UK after having acquired or always had long-term resident status. The length of time that these leavers remain in scope for IHT will depend on how long they were resident in the UK before leaving, with the maximum tail being 10 years. Trusts established by long-term residents, regardless of whether the settlor was a long-term resident at the time of establishment, will also be in scope for UK IHT. And what this means is that if a chargeable event, such as death or a 10th anniversary, occurs at a time when the settlor is a long-term resident, the trust assets, even if non-UK situs, will be included in the settlor's estate as a gift with reservation if the chargeable event is death and the settlor is a possible beneficiary under the trust. It also means that the trust assets, again, even if foreign situs, will be subject to a periodic charge if the chargeable event is a 10-year anniversary. Settled assets may therefore be coming in and out of charge depending on the resident status of the settlor from time to time. And inheritance tax exit charges may apply where trust assets cease to be relevant property as a result of a change in the long-term resident status of the settlor. And this could inadvertently catch UK domiciled UK resident clients who create basic gift type discretionary trusts and then retire abroad and consequently cease to be a long-term resident. Their trust was within their property held in their trust was within the relevant property regime. They cease to be a long-term resident and it falls out of the relevant property regime and there's an IHT exit charge. There are, however, some exceptions for trusts that weren't expected. In particular, where an excluded property trust was created before the 30th of October 2024, i.e. before budget day, no gift with reservation will arise on death of a settlor who's a long-term resident at the date of their death, although the trust may still be subject to inheritance tax, periodic and exit charges. In addition, where the trust settlor of an excluded property trust dies before the 6th of April 2025 and was domiciled outside the UK when the trust was established, the trust won't be subject to the relevant property regime for the duration of its existence, provided that it continues to hold excluded property. Although a difficult one to approach, this does present an opportunity for non-domiciled clients who are in health to establish trusts that could then remain inheritance tax-free post-death and for the duration of the trust's existence. For other non-dom clients, inheritance tax mitigation advice will move essentially to the same basis as for all UK domicile clients, with discounted gift trusts and loan trusts becoming relevant to all. In contrast, UK domiciled clients who are considering moving overseas in the long term might want to take advantage of the potential to invest in excluded property, i.e. overseas assets such as offshore bonds, which will cease to be within the scope of UK IHT after they've been non-resident for 10 years. For financial planners, the new residence-based regime does have the advantage of simplicity, as determining someone's resident status and therefore their exposure to UK IHT will be a lot easier than determining their domicile status in many cases. While the exemption from the gift with reservation rules for excluded property trusts settled before budget day will be welcomed by non-DOMs planning to remain UK resident for the foreseeable future and who didn't quickly act to exclude themselves from benefit before budget day, advisors will need to be mindful of the fact that clients' trusts may slip in and out of the relevant property regime, potentially giving rise to exit charges that might be unexpected as the client's long-term residence position changes. And this might be difficult to monitor, especially in cases where UK domiciled UK resident individuals have set up discretionary trusts holding offshore bonds without any expectation that the assets may become excluded property if they, for example, retire overseas. So thank you for listening. What I'm now going to do is move back to everyone for the Q&A session.
So I'm hosting the Q&A. There has been a lot of questions and a lot of questions on pensions. So I've tried to answer a few of those because you don't want to just listen to me going on. So I'm going to try and pick up one on stamp duty. Who's picking up stamp duty? Is that you, Marcia? Yes, thought it was. So Daniel says, do we know if the 2% increase to stamp duty for additional property purchases is applied to limited companies as well as individuals?
It will, yes. So it applies to everybody who has to pay the surcharge. So that includes limited companies who pay stamp duty on acquisition of property. So even if it's transferred to them in return for shares, and also to trustees of discretionary trusts.
Excellent. So let's just have a quick look at another one. Right, one for Niki. How does the real application of pre and post October 30th disposals work for the annual exemption?
Okay, so basically, generally, you would work out your gains for the year, deduct losses, and then apply the annual exemption, as I mentioned. According to the policy paper, the existing provisions under which losses, the annual exemption, and any unused income tax basic rate band that can be used in the most beneficial way will remain in place. And there's just going to be some amendments to reflect the changed rates. Look out for it. What I'm going to be doing is I'm going to write a bulletin and do some examples. So look out for it on TechLink for those of you that subscribe, and hopefully there'll be something up next week.
Excellent. Right, this is quite a long one, and it's a long one for Tony. So hopefully I can read this right. And thank you for who submitted this question. Right. On the face of it, there's a window to complete a business sale before April 4th. I'm assuming we need 5th at current rates. But what is meant by the anti-forestalling section about the timing rule in section 28 of the TCGA 1992? Does it mean that completing a BADR transaction pre-April 2025 will still be charged at 14% or 18%? I'm going to stop there and then pick up the second part.
Could you just repeat that? No, sorry. Sorry.
I
I think the point there is, and it's a really good one, because anti-forestalling provisions were introduced a couple of years back when there was anticipation of a increase in CGT. It basically said if you had an unconditional contract. So the general rule, it's going to be a long answer now, I'll try and keep it short, but the general rule when you're contracting, is it's the date of the contract is the date of the disposal. So when you enter into the contract, even though you haven't completed the transaction, the contract was entered into, that's the date of disposal for capital gains tax. So some people go, as long as we enter into a contract early, then if we do have an exchange, if we do have an increase in rates, then we'd have banked the earlier rate. So there was anti-forestalling saying, but if you don't complete, broadly speaking, within 6 months of that date on an unconditional contract, then we're going to treat it as when you entered into the contract, where we're going to treat the disposal as being taking place when you make the actual transaction, when the transfer of assets takes place. So I think in this case, given where we are, we're in November, and we've got till April before the new rates come in, that isn't within the 6-month period. I think the anti-forestalling, we'll look at this in more detail, won't apply. So if you have a business and you have a buyer and you're ready to sell and you can do all of that and all the commercials have been done, then if you sold now, you would be in the current regime in relation to the business assets disposal relief. But anything above that would, of course, be subject to the higher capital gains tax rates because they came in on the 30th. The BADR change from the 2025. If you contract now, complete the contract, you'll be okay.
The second part of that, which might be a little bit, how would HMRC know?
Is that really? Well, because you have to disclose when the contract was made. There's documentation, or the whole thing around how would they know. Never underestimate what HMRC would know. And there is clear evidence when you're making a sale that a sale took place. The documentary evidence is not difficult to discover. So yeah, never go down that route of that. If there's a planning based on how would HMRC know, don't do it, basically.
Excellent. Right, we have another one again for you, Tony. And this will be another challenge. Salary versus dividends. Have you done the calculations for Scotland with the higher income tax rates?
We will be. We haven't yet, but we will be, and they'll be on TechLink with those grids that we normally have. So no, I haven't done them just yet. But a very good, esteemed colleague of mine is working on them.
That's what we like to hear. That's what we like to hear. Okay. Simon says, can you comment on the ongoing effectiveness of EPTs, both for funds currently held within one, funds invested between now and the 5th of April 2025, and anything thereafter?
Yeah. So basically,
yes.
So essentially, like I was saying, we've now moved to a system of residence. So it's all about where your client is resident. Now, if your client is long-term resident, so assuming your client is long-term resident in the UK, has been here already for 10 out of the last 20 tax years, then and they've created an EPT at some point historically, then once the new regime takes effect from 5th of April, if they die after that date, then they won't have the value of their trust fund included in their estate for inheritance tax purposes as a gift with reservation, even if they are able to benefit. And obviously most people are able to benefit under excluded property trusts, so unless they've taken steps, like I said, to exclude themselves from benefit quickly before budget day, then they still get that benefit of being able to have access to those funds without them being part of their estate. And that benefit will continue whenever they die, as long as they created their trust before budget day and they were non-UK domiciled, and obviously not deemed domiciled either before they created that trust. However, that trust will then come into the relevant property regime. So it means that if they don't die and a 10-year anniversary occurs after 6th of April 2025, then there will be a periodic charge. We don't have all the detail yet, but it's likely that the periodic charge will be restricted to the, so it won't be as much as it would be if the property had been relevant property for the full 10 years. It will only be, it would only be in a relevant property for a short time, so it will be a reduced charge. People that create excluded property trusts between now and 6th of April 2025 won't have any benefit from them after they've become long-term resident, unless they can die before 6th of April 2025 as well.
We don't promote dying, just saying.
If they create it and then they die also before the 6th of April 2025, then they will get all the benefits that we've always historically had from excluded property trusts for the duration of the trust's existence.
Excellent. I think there's a few more for you, Marcia. I'm gonna do a pensions one. Give you a breather. Peter has asked, can we address the assertion of Rachel Reeves that IHT was applicable to pensions prior to the 2015 pension reforms? Personally, I think it was a slight wording issue. I believe that the point was that you couldn't pass them down the generations. If you used binding nominations, then they would become subject to inheritance tax rather than discretion, because you could override the rules regarding where you paid them, and that would bring them into the estate, for example. So there were cases where pensions were subject to IHT prior to that, but the ability to name a wider band of beneficiaries meant that was taken out. I think the bigger issue here was that the taxation on pensions prior to 2015 was different on death benefits, and what they're trying to do is change the notion that pensions are really for legacy planning rather than for income in life, and that's where the differences there I think will be something that is the real driver. Someone also mentioned in one of the questions, I haven't got the exact wording here, that she mentioned lifetime allowance in reference to pensions when she was talking about it. I think actually she's probably talking to inheritance tax allowances rather than pensions allowances. So as far as I'm aware, they're not planning on bringing the lifetime allowance back, but we do still have a limit on the amount of tax-free pensions that can be passed down in addition to the IHT if paid as a lump sum. So the lump sum and death benefit allowance has failed, is still around. So they haven't got rid of that. That's not been taken away. So you may have a case where inheritance tax is payable on some, it's still larger than the lump sum and death benefit allowance. So the lump sum and death benefit allowance will then create a charge on the additional residual funds. That's pre-75, post-75, everything would be subject to income tax anyway. So there's some differences there. Right. A little bit away from pensions, I'll come back to. There's a shed load of pensions queries. I think I've answered 50 online already. Business asset relief. So if business asset relief assets are placed into a trust after 2 years, will this remove them from the estate and therefore remove them from the £1 million new allowance?
Well, there are some anti-forestalling provisions here as well. So if you make transfers into a trust or indeed outright transfers to anybody after budget day, I think it's after budget day, let me just check the rule there. I think it's after budget day. Let me just see. Yes, after budget day. And then die on or after the date that the rules take effect, after 6th of April 2026, then the new allowance will also apply to those failed transfers of business or agricultural property. So that's one point to bear in mind. However, if you do transfer to a trust before 6th of April 2026, then you would appear to be able to do so without any immediate IHT charge, regardless of the value transferred. Your trust will also have its own 1 million allowance for 100% relief. So you could feasibly transfer 1 million of shares to a trust before 6th of April 2026, and you would then have your own 1 million allowance, and your trust would have its own 1 million allowance, or so it would appear. Like I said, at the moment, we've only had a sort of very brief policy paper, so we haven't had the legislation, so we don't know all the detail. But the other thing to just bear in mind is that, like I was saying when I spoke about it, is that if you do transfer, let's say, for example, unquoted shares in a trading company to a trust, and they grow in value, and your trust then has an IHT liability itself on that excess over the 1 million, how is it going to pay the charge? So that is just something to bear in mind there.
Excellent. Furnished holiday lettings and the changes there. Who's picking that one up? I think it depends what the question is, I guess. So furnished holiday lets inside a limited company. Do the same rules apply remortgage reliefs?
No, they won't. So essentially, yeah, at the moment, individuals don't benefit from a mortgage interest deduction on residential property holdings unless they are furnished holiday lets. Companies do benefit from that mortgage interest relief deduction on rental income, and will continue to do so regardless of whether the property that they own is a buy-to-let, a furnished holiday let, or whatever it is.
Excellent. Right. Umbrella companies. I think we've had one on that. Is anyone umbrella company experts on? I've now lost the question, which doesn't really help matters.
No, that really helps.
It does, doesn't it? We might have to come back to that one. Oh no, there we go. Can you comment on any changes for contractors who work under umbrella companies? I've seen a few of these clients, and there was some reference to IR35 in the budget. Did anyone see any references to IR35?
I haven't looked at that.
No, I haven't. There was mention to say there's going to be a little bit more in terms of tightening up rules, and also tightening up rules for promoters of tax avoidance, as always happens in every budget anyway. But we haven't looked at the detail of that just yet.
There we go. So Rachel, that's where you heard your reference, but doesn't sound like there's any detail.
It came up, I think, in relation. It's all in relation to the increased costs of employment and national insurance, and they're basically saying, watch out for any schemes purporting to get you out of it. Just before the budget, there was a case reported of attempting to go through a limited liability partnership, get your money out as partnership income as opposed to earnings, thereby avoiding national insurance. So it was wrapped up in all of that. I think if you've got a straightforward umbrella company and you're receiving your money and you're paying NIC on it normally, then there shouldn't be any change, I don't think. But as we said, there's more to emerge on this. I think that's what that question was referring to. It was to watch out for trying to avoid this by being self-employed or doing any way to get your money out of a business, as has happened with employee benefit trusts in the past, without paying what should be paid on what is really income from employment.
Excellent. Right, back to CGT and talking about getting money out of your company. How does the increase in CGT affect sale of businesses with the earnouts over a period of, say, 3 years?
The rules haven't really changed as to when these are quite complex in terms of conditional contracts and payments in installments as to when the disposal takes place for capital gains tax. And generally speaking, if you make a disposal, sell your business, contract is entered into, and you don't get your money for 3 years, but it's not conditional. You absolutely know you're going to get X pounds in year one, X pounds in year two, X pounds in year three. then you're taxed on the discounted value of it when you make the disposal. If there's any kind of jeopardy, any kind of sort of earn out that is undetermined, then you can ensure that you only pay the tax liability effectively when you get the amounts, but you need to structure the sale documents to ensure that gets you that outcome. It's quite complex stuff. There's been a lot of case law on it and some very detailed legislation, but with the right advice, then you will get your tax liabilities to match the time when you get your money. But getting the right advice and having the right documentation to make sure that is the outcome you achieve is absolutely critical in my experience.
Excellent. Just to cover off a good number of questions, I believe there will be a recording of this available on TechLink for our subscribers. Yes, so that is absolutely brilliant. Agricultural disposal relief for a small partnership. So in essence, will each partner be treated as a sole trader? So will they have 1 million disposal allowance each?
So are we talking about agricultural property relief for inheritance tax purposes here, or BADR CGT?
If it's a disposal, what sort of disposal? A sale or a gift?
How will agricultural disposal relief work for a small partnership? That's the
I mean, in terms of IHT, every partner will have their own 1 million allowance, whereby their partnership interest up to the value of 1 million, their own partnership interest up to the value of 1 million will qualify for 100% relief, and any value over and above that will qualify for 50% relief. That's the IHT answer. In terms of business asset disposal relief, the answer is probably the same, because it's an individual. Partners are individuals. They are not connected. Well, they are connected, but not in a way that prevents them from qualifying for their own individual allowances.
Excellent.
Yeah, agreed.
Perfect. One on non-DOMs, Marcia's favourite topic. When does IHT on worldwide assets start for non-DOM UK residents, i.e. residents for 5 to 9 years? Are these assets only liable for IHT after 10 years out of 20 in brackets?
Yes, that's right. So while those people remain or are not yet long-term residents under the new definition, their overseas assets will not be within scope of UK inheritance tax. They will only come within scope of UK inheritance tax once they've been here for 10 out of 20 tax years, after the last 20 tax years.
Excellent. Oh, they're getting very technical now. Even I'm not understanding what they're writing.
It's not pension.
It's not about pensions, no. We have a question about discounted gift trusts. Will discounted gift trusts still have benefits of partial IHT and loan trust growth still out for IHT, or is this all going back in?
No, everything will still be the same as far as discounted gift trusts and loan trusts are concerned. So it's just that with your non-domicile clients, who are going to be those become those long-term residents because they've been here for 10 years, it's just that they will then achieve the same benefits as somebody who's always been UK resident and domiciled would obtain from a discounted gift trust or a loan trust. So those products will become relevant to those category of client in exactly the same way as they are currently relevant to UK domiciled, UK resident clients.
Excellent. I'm just going to pick up a pension one. There's a lot of queries regarding bypass trusts, so I'm just going to touch on those. They often have product names such as the LPT, APT, for example, and people might recognise when I use the terminology bypass trust. That's what we're talking about here for some people. And within those, what we see is those trusts, the bypass trusts, are a trust set up independently of the pension, and they are only there to receive the funds on death. So when I'm talking about things being tested for IHT, that happens first. So you don't wrap the bypass trust around the pension. It's not going to take it out of this regime. However, there are still reasons to use them. The reasons to use them are if you have, say, a very large pension and it's paid into a bypass trust, that IHT charge will happen once. It will happen once on the way before the money is paid into that. And then you will deal with the trust and it will be outside the pension, so these pension rules will not apply. However, trust rules will usual periodic charges, exit charges, all of that still needs to be considered. I'm not going to get into that, not my bag. However, if you were not to do that, you go, actually, I'm going to put it into dependence drawdown, for example, and I'm going to put it straight into dependence drawdown. The IHT on that would be payable in the first instance on first death. The dependent would receive it. If there's still a pot, that money would also then be tested against that dependent's estate on their death. And again, onwards and onwards and onwards. So bypass trusts still do have a really good thing. I think there might be a resurgence in some cases. It's definitely worth considering, though, the spousal exemption on all of this as well, because that will factor into whether or not you want to put it into a bypass trust on first death, maybe on second death, or consider what the options are there. So it always depends on the options on your pension scheme as well. We have had some questions about public sector death benefits as well, and those public sector death benefits actually quite often fell into the estate anyway, if not passed to the spouse, because interestingly, public sector death benefits are not discretionary. So they were binding nominations, which meant they were subject to IHT and part of the estate anyway, but were generally exempt because of the spousal exemption. We've had a lot of other questions about death in service as well. What falls in, what falls out? The dividing line is the death in service in a pension? You know, is the death in service written in a pension wrapper? So it could be within the wrapper and it pays into the wrapper and the wrapper pays out, or it could be accepted group life, which has got nothing to do with pensions, completely separate, and therefore doesn't fall into these tests now. So that's the defining point. Is it in a pension? So it would be subject, historically you go, would it have been subject to the lifetime allowance? If it would have been subject to the lifetime allowance, it will fall into these IHT rules. If it wouldn't have been subject to the lifetime allowance tests, then it wouldn't be subject to these new rules. So if we think about how can we judge it on things we know about, then that's the best way to do it. I'm going to do one final pension one. So we've had a good number of questions, and Marcia, you might want to comment on some of this as well. When we're looking at inheritance tax on pensions, what we're looking at is the value of the fund. We've had a lot of queries about whether a SIP or a SAS, they will have a look through, and whether or not there'll be additional allowances depending on what assets such as agricultural land or property were held within them. Having looked at the regs myself, and I'll ask Marcia's opinion as well, having looked at the regs myself, I don't think it matters what the assets are. It's just the value that they talk about, because that's how pensions are valued. They don't consider what the assets are. So there'll be no difference between a SIP or a SAS, whether they're holding commercial property or whether they're holding agricultural land, AIM-listed shares, anything like that shouldn't make any difference, probably, unless they look any further, to the value of the pension that is calculated for the IHT test. Marcia, any thoughts on that?
I'll be honest, Claire, I haven't looked at all that in detail. So
it just doesn't mention it. So
yeah. Well, you just don't know what's going to come, do you? But
no.
But yeah, I would agree.
Yeah, they've not been benefit for any exemptions on anything generally held within a pension. Usually, it's being CGT, and all of those things are free from the other taxes within. There's generally just the look at what's the value. And having looked at that, there doesn't appear to be any flow through, although we were pleased, obviously, to see the spousal exemption, because that actually would have been really harsh if they hadn't included that.
Yeah.
We're running out of time, and I'm running out of steam of trying to read through all the queries and questions. What we will do, I'm just going to say nearly 300 questions. Good on you lot. Well done. We will try and pick up as many as we can. A lot of them will have been answered within the session. Anything particularly detailed, anything very personal as well, we will pick up separately. We have your details. We know where to find you mostly. So leave it with us. And I think just probably some time for us to pass back to Tony. Did you want to say a few final words on the budget?
Yeah, just a few. Thanks, Claire. Only just to say, hopefully you've got something from what we've all said and contributed this morning. As we've all said, pretty much there will be some more detail to emerge on many of those issues, and we'll be doing our absolute best to keep on top of that. What has become clear to me, and hopefully to all of you, that the budget, especially this one, represents an excellent time for you to engage or re-engage with your clients, to review their financial plans and make any necessary adjustments to ensure that optimum outcomes are likely to be secured. Running this kind of periodic and timely tax health check effectively throughout the client's financial planning journey will also represent, I think, a valuable and recordable evidence of the value of advice and the relationship with the advisor. Always a good thing to do that. And when that's done well, you deliver what we like to call tax alpha, which is a key contributor to overall advice alpha. Effectively, the addition that you make to your client's bottom line as a result of your advice, not the market, not the charging, none of that, what you know and what you can do for your clients. So thank you all so much for being with us this morning. We really enjoyed being here. Hopefully you've enjoyed it too a bit, as well as getting some information. We know your time's valuable, so I hope that you found that the time has been well spent. So we at Technical Connection really value our relationship with you, as Claire has said, and remain completely, be assured of this, completely committed to delivering the insight, responses, and the proactivity, which is really important. I'm sure your clients know that you value to help you deliver that alpha to your clients. Keep a close eye on the TechLink bulletins for all of the latest updates on all of that extra complexity that we are going to get. And the budget announcements as they come forward and they move forward to become law, we'll be keeping on top of it. So thank you all once again. Have a brilliant rest of the day and an even better weekend.